Welcome to this Killik Explains finance video. This week, a slightly unusual source for inspiration for the video, the Fonz. Some of you may remember Happy Days. Some of you may remember the part played famously by Henry Winkler. Well, he's still around and he's got some good advice which I think applies equally to investors as it does to aspiring actors and authors. So, I'll explain more in a moment. Now, the background is basically what? Well, actor Henry Winkler played the Fonz in Happy Days. You may remember his signature E, or you may not. But basically, that part made him famous. But then he struggled a little bit afterwards. So, at 73, which is what he is now, he won his first Emmy. He was late 20s when he played the Fonz, took him to 73 to win his first Emmy for a completely different part, 42 years after he was first nominated. And he believes his success is built on three tenets. So a lot of people wrote him off. They said, well, you're the Fonz, you'll only ever be the Fonz. But actually, since then, he's been a very, very successful children's author and returned to acting, despite quite a big handicap, which I'll talk about in just a moment. So, what is the secret to his undoubted success? And I quite like this from an investing point of view. Word number one is tenacity. I'm telling you, that might be one of the most important ingredients for a human being. But actually, there are two more on his list, aside from empathy and gratitude. And that got me thinking that those are great life words for human beings in general, but for an aspiring actor and author, they're actually quite important for investors. And I'll try and explain why now. So, how can an investor apply those three key words to the way they approach investing, if you like? Tenacity, number one. This is pretty key. All of what we describe is built on the long-term approach. Now, Winkler certainly had a long-term approach. He basically didn't play the Fonz until he was 27, despite the fact that was meant to be a teen character. So he joked that made him the oldest teenager on the set. His dyslexia stopped him from getting parts earlier on because basically he couldn't read the script. He had to sort of give an interpretation of it. He couldn't actually read it and then read it back, if that makes sense. So having played the Fonz, he then couldn't get work again because he was known as the Fonz. So what he did was, rather than just say, well, I'll sit back, give up, he diverted his career into writing a very successful series of children's books and then diverted it again back into a different type of acting role, which is where he got the Emmy from fairly recently. So tenacity is certainly something that he has in spades. From an investment point of view, long-term investors must stick to a plan. So tenacity is important there too. It's really key that you're not blown off course by the media, short-term noise, Brexit, Donald Trump, what's happening to oil prices in the short term, all of those things. It's very important that investors basically devise a plan, stick to it. Remind you about how we devise plans in just a moment, and don't run to cash. Very tempting when markets are volatile as they are now to think, well, I'll just hide in cash for a bit, go back into the market when it settles down. It's really difficult to do. Number one, you pay a load of transaction costs for going into cash and back out of it again. Number two, timing when the market might recover is almost impossible. And three, in the meantime, you're sitting in an asset that's paying you less than inflation. So you're basically losing money sitting in cash. It's not a good idea. It would be if you could predict the direction of the market, but no one can do that 100%. Now, this just makes the point about long-term tenacity as an investor. Yes, this is hardly a smooth, flat line, that's for sure. There are massive dips. This is the S&P. The FTSE is quite similar. Massive dips. We've had financial crises. We've had dot-com boom and bust, Asian crises and so on. But nonetheless, and whilst the past doesn't guarantee the future, nonetheless, the trend has always been upwards. The stock market has always bounced back, and in some cases bounced back extremely strongly. And some of its best days, ironically enough, often follow its worst. So if you're sitting on the sidelines in cash, you suffer a double whammy potentially. Now, just to put some stats on that, since 1928, these are from Stern NYU, cash has beaten bonds and stocks in only 13% of calendar years. Lengthen the time horizon 30 years and that becomes 0% at the time. And stocks come out top in 61% of single years, 80% of decades, and 100% of 30-year periods. So you've got to be prepared to make a plan and stick to it for that statistic to work for you. But you can see that stock market investors that are a little bit tenacious know what they're about, know what they're trying to achieve, and stay with the program, as it were, do normally, whilst there are no guarantees, eventually win out. Now, he also talked about empathy. So how does that relate to being an investor? Well, for him, my dyslexia, which wasn't diagnosed until I was 31, was often mistaken in school for stupidity or laziness. So the crowd, defined as people like his father, headmasters, people who were basically auditioning him, assumed he was much more stupid than he actually is, because he struggled to read a script, let alone memorize it and relay it back. He got around that to get the part as the Fonz, by the way, by basically saying, well, I'll give you an interpretation of the character and worry about the specific lines later. And that approach works, quite a clever idea. But he was often stymied by the fact that he couldn't learn and read scripts. So the crowd made assumptions about him which he later demonstrated were completely wrong. The Fonz is one of the best known characters ever, possibly in US TV history. Now, how does that relate to investors? We'll come back in a moment. For investors, betting against the crowd is important, but to bet against the crowd, you've got to understand the crowd. You've got to know what mood the crowd is in. In other words, in order to be greedy when others are fearful and fearful when others are greedy, as Buffett put it, you need to be able to read the mood correctly. To do that successfully, you've got to be able to do, I would argue, at least three things, or read three measurements correctly, and we'll come to those in a moment, and then have the courage to stick to a different approach. Winkler certainly did that with his auditions. As an investor, you've got to be prepared to buy the unpopular stock sometimes, sell the popular stocks. It feels deeply uncomfortable, it feels unnatural, it won't be what your mates are talking about in the pub necessarily, but it's an important part of potentially giving yourself a leg up when it comes to long-term investing. Now, how do you measure mood? So how do you know what the crowd's thinking? Well, it's not easy, but there are ways. Volumes. To what extent is a market move underpinned by rising or falling volumes? Volatility. That's quite important. Is the market heading steadily in one direction? It does so for quite long periods sometimes. Or is it showing signs of increasing or decreasing volatility? And it's the trend that's important, because that gives you a feel for where the mood of the investment crowd is going. And then volition, or sentiment as I call it. So 3 V's, slightly engineered you might say: volumes, volatility and volition. There are other measures. Sentiment is all about getting hold of data, and it does exist, about whether investors, fund managers, are net bullish, neutral or bearish, and then taking the counter view. It's not willfully just not doing what other people are doing. It's measuring crowd sentiment and taking a calculated estimate on where you're best positioned to take advantage. Finally, gratitude. And this is not to be confused with another word that begins with GR, greed. In other words, investors should be grateful. What do I mean by that? What I actually mean is, Winkler put it like this: gratitude is like a food group, it's essential for being alive, and it's quite an important part of investing to stop you tipping over into what I call dangerous levels of greed. Now, what do I mean by that exactly? Investors need to plan and then stick to a plan. In other words, identify those 3 buckets we talk about in other videos, or I certainly talk about. Get your rainy day fund in place. Get your foreseeable calls on capital, those cash requirements that fall due within the next 5 to 10 years. Get organised to meet those, and then put the rest of your money to work in a basket of equities designed around your preference for risk and what you're trying to achieve, and so on. And then stick to it. In other words, don't chase the latest hot idea. Don't liquidate part of your portfolio to meet a sudden short-term call on capital. Don't dump trusted long-term dividend payers just to get into the latest hot sector. Be a little bit measured about it and reallocate your funds systematically. As those foreseeable calls on capital arise on whatever you're using, your spreadsheet model or your cash flow model, then reorganise your funds accordingly. So you've got the money there in liquid form to meet them. In other words, be systematic, be optimistic, take advantage of market opportunities, but don't let that tip into greed. Gratitude, not greed. Now, there it is. Henry Winkler's life lessons converted into 3 lessons for investors, if you like. If you'd like to know more about either him and his view on life, or the way that I think those tenets can be applied in investing, usually email address applies. And if you want to watch some videos that take those 3 V's I mentioned into a bit more detail, then it's killik.com/learn and the shares tab.